Good evening. The presentation of the economy markets. What I thought is that since we are presenting a large cap fund to you, you should spend a little bit of time thinking about what happens across large, mid, and small. When should you allocate more to large cap? When do you allocate more to small cap? So let's look at the past track record. And when you look at the returns as of last month end, you can see that the large cap, mid cap, small cap index from 1 month up to 1 year, right, have all returned positive returns, and the trend is that the small cap seems to have done better than mid cap better than large cap. So you must be wondering, if they are giving the better returns, why is Sundaram not in large cap? This is the right time for large cap. So to that point of view, I'll say take yourself back 4 months back to 31st of March, right? The same 1 year return, which today is 6, 12, and 16 and a half, was then minus 0.5, which is almost flat for large caps, minus 25 for mid cap, and minus 33 for small cap. So it was a very different picture just 4 months ago. And 3 months prior to that, prior to the COVID crisis, you saw large caps actually delivered a 14.5% positive, whereas most mid and small were negative. So in the space of 9 months, you've seen a bewildering variance in terms of A, profit versus losses. Second, in terms of who is the leadership in the cap curve. So what explains this, right? So what is this? That this is just over 9 months. Let's look at it over a longer period, because you're not making investments for 9 months, you're making investments for 3 to 5 years at least, right? So to understand this, there's a methodology analysis called rolling returns methodology. This is nothing but taking, suppose you have a 3-year outlook. It's taking 3-year returns every day for a long period of time. So get enough 3-year returns to make a judgment call on, in 3 years, is a large cap better, mid cap better, small cap better, or does it vary across time? Right? So in our analysis, we have taken a 16-year period starting from January 2004 up to August now. So in these 16 and a half years, you have 4,992 3-year periods observation, right? So you have a solid base to make a judgment call. And over 5-year returns, if you want to look at, there are 4,200 observations. And if you want to evaluate 10-year returns, you have 2,500. So you have a large base of observations. So whatever conclusions we drive, because I'm going to use this a lot in the course of this evening, you can feel that it's reliable and it comes across good times and bad times, because over a 16-year period, you know, there have been good times and there have been bad times. So what can you see here? You can see here that the average returns, whether you choose large, mid, or small, have been by and large in the early double digit, 12 to 14%, right? Maybe 10 if you go slightly longer. So there's not really much difference in average returns. But let me tell you that when you read down there, right, these are misleading. Why? Because nobody ever gets the average return. You take the Ganga River at Haridwar, you know, it has got a certain depth. At Rishikesh, it has a certain depth. On an average, you will say Ganga is 3 feet deep and you can't walk across. Because you don't know at that particular point, is it 3 feet or 20 feet? So that's the point being that similarly, if you want to get a sense of your returns, you cannot take the average and say this is what I'll get average over time. So I just gave these to demonstrate the misleading nature of averages. And so the degree that this varies around the average is known as volatility or risk or standard deviation, multiple names for it, but all of them mean one thing, that is they give you a different returns depending on when you invested. So when you now look at it and say, okay, in a 3 years, what did I get maximum? Or in a 5 years, what did I get maximum? And what did I get minimum? That is, if there is a loss, what is the minimum maximum? Loss I suffered. So there you can see very clearly. Let's discuss the 3-year periods. Over almost 5,000 observations, we saw that when the timing was good, large caps gave you 48% per annum. Mid caps gave roughly the same, but small caps give you 70% per annum. So clearly, while an average was roughly the same, you can see that the maximum revenue got from small cap was 22% per annum better than a mid cap. And you say, how great, then I should always invest in small cap. No, the point is there is variability. So when you suffered a loss, you lost 8% is the max loss you faced per annum on a large cap index, but you lost to 21% per annum in a small cap index. So can you see that the high returns comes with high risk of loss? So that's what I say, that when you look down, you'll see that clearly large caps give you better protection in bad times, but not as much return as mid and small cap in good times. So then, as you can now figure out, in your investment, you've got to make a judgment of, is the times going to be good or the times going to be bad? So to put this into perspective, So what this means is that overall in the asset allocation, this is a risk reward line. There's low return to high return on the y-axis, and there's low risk to high risk on the x-axis. And as you can see, large caps in the median of that, which means that they are riskier than debt funds, but within the equity, they are the safest asset class, right, in terms of the risk return framework. So now we come back to our question: large, mid, and small. What are the basis for deciding? As just first line I've repeated. So what you need to do is to try and get your good times, bad times prediction right. Then you can make the perfect switch from large, mid to small, minimize your losses, maximize your returns. With that being in mind, what decides good times and bad times, right? So I believe that we all know that there are two certainties in our life, right? There's one is our death, and the second is the taxes that we have to pay. But there's a third in the financial world that's also a certainty, and that is the existence of business cycles which affect economies and markets. What does a business cycle come up due to? Why is this cyclicality? For the simple, very simple reason that demand and supply don't always match. When they are matched, there's perfect equilibrium. But generally, you see there is a mismatch. Reason being that demand grows linearly, 5% per annum, 10% per annum up, or 5% per annum, 10% down. But capacity, that is supply, comes in bulk. Like you take Hero Honda, for example. They make motorcycles. Let's say that they have a capacity of 100,000 motorcycles. And let's say this year they are selling 95,000, which means today they are operating at 95% capacity utilization. Next year, they expect a 10% increase in the demand. So which means they need to sell 105,000. They don't have the capacity. Now, when he has to add capacity, he can't add just 5,000 motorcycle capacity for this year. Then the following year, add another 10,000 and then add another 10,000. It doesn't work that way because you need to acquire land, building, plant, machinery, borrow money for it, etc. So you set up for 50,000 motorcycles. So what happens then is that you set up 50,000. So this year's 95% capacity utilization next year goes to 105 divided by 150. So that's what? Roughly 70% capacity. So straight away the capacity has dropped dramatically. Why is this important? Because this affects GDP, it affects profits. Because when demand is more than supply, the consumer is at the mercy of the supplier. So the price is set by the supplier, the producer, the manufacturer, whatever. But when supply exceeds demand, the pricing shifts to the consumer because there's lots of choice. So this affects the profitability of companies and the economy. So that's where you have cycles, and all that I have described, now I'm putting it graphically. So the bottom half, so the first of all, the left-hand side circle is the virtuous cycle. That's a good cycle. The right-hand side is a vicious circle or a bad cycle. So the bottom half is what I just explained, right? When a good cycle, there's high demand. This demand is greater than supply. So the profitability of companies is high because they set the price. Their capacity utilization improves as the sales goes up. So they reach their peak capacity, they put higher investment and they produce more goods, which then brings down the inflation, the interest rates. And when interest rates come down, it makes it easier to buy more cars, more auto, right? Because you get cheaper EMI. So that's the good cycle in circulation. And suddenly these good cycles turn bad because generally demand collapses due to a crisis. Global financial crisis, coronavirus crisis, whatever. The demand collapses. So the capacity utilization comes down, no further investment on any capacity creation. So supply becomes tight, inflation goes high, interest rates goes high, further depresses demand. So this is the classic way that you get a cyclicality in the economy. And in the Indian economy, this cyclicality leads to cyclicality in the stock market, right? Why is that? Because stock market gives you returns how? Through EPS and through valuations. So EPS goes through the cyclicality because in a good cycle, EPS goes up. In a bad cycle, EPS comes down. Then on valuation, valuation is in turn decided by two things, right? Because the PE goes up, you make money. PE goes down, you lose money. That is what is called re-rating. When you now look at it, how does the PE go up or down? Two things. If future expected earnings, that was current earnings, right? Future expected earnings goes up, then your PE goes up because you think that there's going to be more money at stake. Next, demand for stocks. Demand comes from FIIs, from domestic mutual funds, from retail traders, from LIC, from other insurance companies. A lot of buyers are there. So when demand goes up, prices go up, right? So that's again the P ratio. So these two are also cyclical because the current EPS fall, unless you're at the edge of a vicious virtuous cycle, it means that future EPS also is going to be bad. Now, same way, the flows, what happens? Flows, there are two different things for you to remember, which I shall point out a bit later in terms of the fact that flows affect large caps and mid and small caps differently in down cycles and in up cycles. I will come to that in a little bit. But like I said, what I just said now, business cycle impact all the three of these, and hence your EPS fluctuation and the fluctuations lead to the stock market cyclicality, which is what I've demonstrated here. For your information, we started from April 2003 to today. So over the last 17 years, you have seen 4 cycles in the Indian economy. So 2003 to 8 was a boom time, good cycle. Then 8 to 13, the global financial crisis, subprime crisis, bad times started. When did they end? When Mr. Manmohan Singh, towards the last 6 months, announced the reforms package and kick-started the next virtuous cycle, which was when Mr. Modi came to power. And for the next 3 to 4 years, you had a good cycle. And in December 17, you had a confluence of events. You had negative food inflation, then you had demonetization's impact coming through, you had the GST implementation, and you also had the NBFC crisis. So all of these put together put the Indian economy back on a slowdown into a new vicious cycle. So you can see over the last 17 years, economy has seen 4 cycles. Now in this stock market that I have described, you can see there are 3 lines: mid cap, small cap, large cap indices. I'll discuss them in detail in just a bit, but right now you look at it, the trend is in a good cycle, the markets all rise. In a bad cycle, the markets all fall. Markets rise, markets fall. So the stock market cyclicality follows the economic cyclicality. Now, what does that mean in terms of numbers? So what I've done is the 2 virtuous cycles I've put on the left side of your screen and the 2 vicious bad cycles on the right side of your screen. So if you look at the virtuous cycles, what do you read there? First, it's all green, which means that all the stock market indices deliver positive returns in good cycles, right? That's number 1. But number 2, look at the trend line. Small cap does better than mid cap does better than large cap. These are all annualized returns, right? So 77, 63, 49. The same trend is followed in the next virtuous cycle. So in a good cycle, small caps do better than mid caps do better than large caps. But in a bad cycle, it's reversed. You see that both mid and small cap indices deliver deep negative returns of 8 to 13% per annum, whereas the large cap in the first vicious cycle was flat. In the second vicious cycle, actually gave you 5% positive returns, right? So this is what I have summarized there. So if you get the business cycle prediction right, you can switch from large to mid to small, minimize losses, maximize returns. So before you do your asset allocation, it's important to understand the stage the economy is in the business cycle. Right? Now, one small point here, I said I will explain to you later. Why is it that the large caps alone are able to be flat? Right? You would have expected that they'll have a slightly lesser negative. Right? If economy is bad, everything is bad. That's because when you go back to the previous slide, when I talked about the valuations of this, EPS goes down even for large cap companies. Expectation of future EPS also goes down, but they tend to recover faster than mid and small cap in a bad cycle, number 1. Number 2, you actually see paradoxically more money flow into large caps during a down cycle. Now, what is the answer for this? The reason for that is that abroad, in developed markets, when they experience negative growth, their governments and their central banks print money and put it. And there is exchange convertibility and there is no color for money there. So the money which they print to get their economy back up and running, the stock market participants, the hedge funds, take that money because rate cuts also come with that. So it's cheap money, a lot of money. They take it and they put it where they think they get the highest return, right? And that's where they are betting that the large caps rising ahead in countries like India, which are fast growth countries generally, the money actually in a bad cycle, instead of going to their economy, comes to our stock market. And that's what gives these large caps a defensive nature of giving positive returns in a negative vicious cycle. So that's the point about large caps that I'd like to make at this point. And as we now move forward, you can see that this other reason for this is that whenever you have these cycles and you have large cap, mid cap, small cap, there are a lot of multi-baggers. But the point is that I wanted to tell you is that in the bad cycle in the middle, right? Also, large caps have got multi-baggers, mid caps and small cap also have, these are number of companies. But these multi-baggers is what makes the fund managers also deliver to you decent returns even in bad cycles or in good cycles, right? So with that being said, now it's time then to decide on the large, mid and small allocations to look at the update on our current outlook. I just mentioned to you that we are in a downtrend, so let me start off with that. This downtrend, you saw December 17, the stock market's downtrend, the economy's downtrend also started December 17. So this is services industry plus agriculture, the total of the GVA or equal to the GDP, you see the downward trend, right? So our economy, much before the COVID crisis, much before the lockdown, has been on a slowdown, right? And on top of it, in Q1, we saw that the impact of the pandemic plus the COVID crisis led to a 24% negative GDP growth, by far the worst in comparison with the G7 countries. This growth was shared equally by industry and services being 38% down. Agriculture came with the saving race with a 3% positive, right? Now, this clearly then tells you that we are still in the midst of a vicious cycle, right? So, in that sense, the economy naturally leads to cyclical in the stock market. So, first thing is that in that chart you saw, right? Current earnings, future earnings, demand. Let's look at all the three. So, you see the current earnings in that quarter, the 23% negative GDP growth led to an overall market's 28% negative sales growth and a 51% overall market's profit drop. And 71 if you take away the banks, which had a good time because they got cheap money and they didn't face NPAs because moratoriums were there. So the take away the banks, the market earnings are down 71%. So that indicates the earnings has not been great. But if you break it up into large caps, mid caps, small caps, and micro caps, you can see that the more the pain is in the smaller end of the market. So micro caps are down 500% in terms of their earnings growth. Small caps are down about 79 if you take it with the banks. Mid caps and large caps are at 58 and 55. So you can see that another reason that large caps get affected less is that earnings gets affected less even in the severest downturn. Yes, it is very bad, but not comparable to the level at which small caps are down, right? So based on this, you can say the immediate outing also is still weak, right? So now you see that I just explained to you, large caps are less affected because in all the three parameters, they get less affected than mid and small caps, right? And when I talked about those flows, I told you that the flows come in. See, even in this bad time, April to now, we have had $11 billion come into our market with FIIs, which is 83,000 crores. And to the extent that the domestic fund managers sold 17,000 crores, they more than compensated themselves. That is why the large caps will be rising, right? Then you see that, hence, in this down cycle, large caps have delivered 5% positive returns, as well as mid cap and small cap are negative. So this way forward now, how long is this vicious cycle to continue? If so, for how long? So that you have to look at it this way, right? There is some positive in this 23% negative. First is that government spending has started. So if you see, the government has been consistently spending double-digit growth in its spending, but in the last quarter they stepped it up to 16%. So as this government is able to sustain it, it's limited by the fiscal deficit and constraint, but at least the government is still spending is something which should cushion the economy. That's a good news. Second is that agriculture growth is already positive, but in the coming months, with the Kharif sowing, as I will show you some slides, has been good. So agriculture growth is going to go up even more in the coming months, right? So, and also that there are green shoots visible in a number of areas. So first is in terms of this whole NPA cycle. You had the moratoriums were coming to an end. So big worry was there. What's going to happen at the end of the moratorium? How the borrowers will be able to suddenly pay all of those 5 months EMI that didn't pay so long? RBI came out in this policy and very clearly then said that don't worry, we will not extend the moratorium, but at least we'll restructure the loans and give the banks enough flexibility to restructure. So they set up a Kamath committee who came up with this report, and as per that report, 66% of all the rated companies in India are going to benefit from this resolution framework, especially those which are already at a triple B and above, 71% of them will be benefit. Naturally, at the lower end, those who are already in PA will not be able to benefit. Which industries are likely to benefit? Construction, real estate, and chemicals are likely to be the key beneficiaries. So, in this way forward, one is the resolution framework, which is positive. Next is the rural India thing. We spoke about agriculture there. So, see this. In that agricultural growth was because of the Rabi crop, which was good. This is about the Kharif crop, which is just being sown. So from 5th January, we have tracked the sowing area. You can see it's fully risen to 100% of the normal area sown, and it's at a 7-year high. So you can expect a good agricultural harvest, and round about the Pongal Paisakhi period, you'll see all this food grain production coming and boosting up the GDP growth, agricultural GDP growth. Second, the lockdown caused migrant labor to go from urban to rural. So the government increased the NREGA payment to 40,000 crores, and that has led to a job demand being satisfied in the rural areas, partly by the government, partly by the Kharif sowing, of 40% YOY rise. Next is the fact that this money in the rural people's hand, they're feeling good about the Rabi harvest, meant that two-wheelers and passenger vehicles, which are largely demanded in rural, are the first showing signs of recovery. You can clearly see the V-shaped recovery happen. Right now, one thing which is that those two are still negative, mind you, but tractor sales with a V shape has actually moved into positive YOY growth because it's critically used in the sowing season. Right on urban India, the slowdown is still there. The recovery has started. It is not as sharp a V as the rural V. Right, there is gradual growth, and if you look at certain key indicators, traffic congestion, for a change, we welcome traffic congestion, that's going up. Then you see that TV advertisement, because people are working from home, spending a lot of time in front of the screens, TV ads have gone up. Government, I said, was spending, so their EVA bill procurement is showing a V-shaped recovery. Then you have freight. Now, across the board, the bulk commodities, cement, steel, coal, fertilizers, all are showing a positive. So overall freight is also showing a V-shaped recovery, right? And electricity consumption, good indicator of industrial growth as well as households using electricity, is showing a V-shaped growth. And to summarize, overall employment, even in urban India, is almost back to pre-COVID levels. Rural is definitely back there. So that's an indication. This is an inverted V which supports that argument. So there are green shoots indicating that in some time you can get back into a positive GDP growth territory. And Jeffrey's economic activity indicator, this puts together a lot of things together, says that we look to be just around 90% of pre-COVID levels in terms of economic activities, right? So our PMI, which is a good forecaster of the future, Purchase Manager Index of the PMI, tells you that a V-shaped recovery is on the way, but that's still at a level of 42, which means it's below 50. Only when you cross 50 will you say you are into a positive growth territory, which has happened for manufacturing, which has just touched 50. So the coming weeks, as it stays above 50, will give you a signal of growth coming back. So in short, there is an expectation of a V-shaped recovery. So in your overall scheme of things, there is a short to medium term expectation of a V-shaped recovery. What do you mean by that, and why do you have that kind of expectation? Apart from this, the government has the powerful tool of lockdown that has a negative economic impact but a positive containment of the infection impact. So that's a reason for the V-shaped expectation. The second is that vaccine or a cure. Every day you have news of some vaccines being tried out, something doing. So I think in a year's time, we'll have pretty much clarity. There will be a vaccine and a cure in place to tackle this crisis, which should give the economy a good booster. So on that basis, this is how the V-shaped recovery looks. To put it into numbers, the IMF came up with this a few months ago, saying that Indian economy this calendar year is expected to be negative growth of 4.5% for the full year. But for the next year itself, that is calendar year 22-21, they will be at 6% positive. So the V in terms of actual numbers is what it looks. So effectively, if you want to break this up into quarter-wise, this quarter you had a 24% negative, right? In the next quarter, you'll have a 9% negative. Then you'll have a 1.5% negative, and then you may have a 1.9% positive in January, February, March. So that is what is meant by a V-shaped recovery. So what it means is that in about 9 months from now is when you think that GDP growth will turn positive and you can then expect that to happen. So how long will this take? This is what is our estimate, right? But that estimate is subject to certain risk factors not playing out. What are the risk factors? First is we contained it very well initially in the rural areas. So the initial breakup of the cases was 80% urban, 20% rural. But in the last 2 months, rural has gone up to 36 and to 47. In fact, the rural case rise at 7.4x is more than double the urban case rise at 3.3x. Right? So that's the risk factor. Why is this a risk? Three major things arise due to this. One, if a large portion of the rural population gets affected, the Kharif harvest, lack of labor can affect it. Number one. Second, if a significant portion of people there are affected, the consumer sentiment, because Diwali is when people are expecting the jump back in growth, will get delayed because that sentiment around Diwali will not be great if every member in your family, or at least one member in your family has got the crisis, or your neighbors have got it, the move to spend will not be there. And the third major risk is that if this goes really fast, then governments may reintroduce lockdowns, which may help in containing the virus but will damage the economy further. So please keep track of the rate at which these rural cases are rising. Right? And another thing, right? I talked about lots of signs of normalization, two-wheelers, cars, and tractors, but two key segments of the automotive industry, that is trucks and buses and three-wheelers, are at way below as a percentage of last year. Trucks are only at 17% and three-wheelers at 39%. So they are core part of economy, and for a real V-shaped recovery to play out, the demand for trucks and buses and three-wheelers also has to match with the recovery of the other segments. And then when you come to the retail selling part, right? Pan-India, North, East, West, South, if you see, though there is a line of recovery, business is still 52% lower in August compared to last August. So that's the warning signal there. So based on this, right, let's now look at the stock market. So you can see that earnings is not going to be great immediate, but there is a chance of a V-shaped outlook in the future. So now when you look at it as a cap curve and look at our large cap space, FII flows, right? And I talked about this before. So FII flows, the reason that it turned favorable and expected to continue that way is that the expectation of a V-shaped recovery in large caps, because people expect large caps to recover much earlier than mid caps and small caps, is that next year, that is 21-22, after 4 years of 450 as an average EPS for the Nifty, the next year we are expecting it 664. So this sharp jump in the earnings of large cap companies is a strong indicator that FII flows which have come in have expected this and will continue to come in, right? The next is the reason for FII flows to be favorable to India is our valuation comparison, interstate with the rest of the world and LTA with our own past. So if you look at it, right, emerging markets as a whole are at most lowest valuations compared to US, Europe, or Japan. And within that, if you look at the valuation of India versus the emerging market, which is the green line on top, and India versus the world, which is the blue line on the top, and the black line is your long-term average. So as you can see, India has always traded at a premium to emerging market and a much lesser premium to the world, but still mostly at a premium. What happened 2 years ago with our slowdown was that this premium started getting corrected. It came corrected till it reached the bottom in the March period. That's when people realized, oh, it's overcorrected because India's medium-term potential is still great. And then FIIs felt that the India was a good value buy and started putting money, and that started coming up. But it's still, as I've circled, it's still not reached the previous high. So India still remains a relatively attractive market on an inter-say basis and in long-term average basis, because our own long-term average premium, right, is being higher than this, right? So this is what the valuation story is telling you, that large caps in their valuation from December 17 are today at 1.3 higher, whereas mid caps and small caps are 7.5 and 3.2 lower. So indication is that future EPS growth of large caps is expected to be much better than the mid caps and the small caps in the initial part of the rally, because the forward PE is 1 year from today. Right? So FI outlook will remain favorable to India, but for another reason also. So this what I talked about is all about FI22. That is, they will recover faster than the mid and small caps from an economic V-shaped recovery happening. Right? But all FIIs don't look only at 22. There are FIIs like pension funds who look 10 years from now, sovereign wealth funds who look at it at 25 years from now. So they also invest now because of the correction, because they think India will bounce back as an economy on a much stronger and much more sustainable basis. What is the thought process of this? Is that India shares strong structural advantages vis-a-vis China. Right? Where does this come from? Comes from the decline in the labor. The red line is the Chinese labor. As you can see, after rising right from the 1950s, 2017 it plateaued and started coming down. Whereas India is on the rising trend till 2050. So this plateauing going down means that China in the next 10 years, 17 to 27, is losing 21 million people from their workforce, whereas India is adding 115 million to the workforce. Next is that because of our education system and engineering and medicine and pharma and everything, we have more than adequate labor compared to our competition in basic, moderate and advanced levels. And another supporting this is that China's per capita GDP is at $10,000, India is at $2,000. So Chinese labor is 5 times more costly than Indian labor. So India has abundant labor, abundant cheap labor, and the COVID crisis has made foreign manufacturers sitting in China increase their intention to move their factories out of China. 44% say it's increased their intention to relocate. So as a result of this, even China's manufacturers are likely to look outside to combat the lack of labor and the higher cost. So Vietnam is their first choice. So 1/3 of the potential $450 billion export moving out, Vietnam is poised to grab, but India is at second point with 69 billion. And in the coming days, we expect this to go up because FDI has been rising in India for quite a long time because of India's attractiveness. But it's mostly been coming into Paytm, Zomato, Swiggy, and the internet kind of startups. We need to make that come into manufacturing, and we need to increase also what is coming. So government has taken a number of initiatives to garner more FDI. For example, cutting the tax rates from 35 to 17 to make it at par with the best in the world. So which is Singapore. All other countries are costlier than us. On top of it, we also removed our dividend distribution tax because that was a tax on the income. FDI companies will try to repatriate back to their country. So making it unattractive, so they removed it. Similarly, they've given 100% tax income to SWF, sovereign wealth funds, for interest, dividend, and capital gains. So government is doing a lot to promote FDI and FII flows. At the same time, the work on the GST, the infrastructure, the licensing, the opening up the limits for FDI, and the finally the opening up of the public sector to the private sector, all have made India's ranking on the ease of doing business, EODB, jump 179 ranks over the last 5 years. So a manufacturer who looked at India 5 years ago to looking at it now is a huge difference. It's a big positive for India, right? And I talked about the fact that we need to change the quality of the FDI into manufacturing. Just one sector I will take to tell you how serious the government is and willing to take strong action to get business in. So this is called the PLI scheme, Production Linked Incentive Scheme. Government has launched a $7 billion plan. What is that? They are promising 4 to 6% on incremental sales for 5 years as an incentive to companies which come and set up manufacturing in India. The scheme closed on 22nd, 31st of July. 22 companies have filed applications. And who are these? These are all suppliers of Samsung and Apple. So Apple is 37% and Samsung 22% of the world mobile market. So 60% of the world mobile market manufacturing is going to shift to India, which means about 11 lakh crore of mobile phone and components will get produced and about 12 lakh jobs will get created. Just one example to tell you what the government is willing to do, needs to do in a whole host of sectors to get more FDI in. But foreigners are confident of this because this Financial attractiveness plus people skills and availability and the business environment put together mean that India has become one of the most attractive countries globally for manufacturing. Come here. So as a result of which, India is well on the way to becoming the third largest economy in the world by 2024. And in 2008, we were nowhere in the top 10. So this is what foreigners are seeing about India. So both the FDI flow and the FII flow, which is directed towards the large caps, is on a very good wicket, provided liquidity is available. And is liquidity available and likely to be available? Absolutely, because one of the globe's response to the corona crisis was rate cuts and note printing and fiscal stimulus. Rates went from 2% global weighted average to 0.2%, almost a 90% drop in interest rates. Plus, look at the way the G4 countries have expanded the balance sheet. That notes printing that I was talking about, they've already done it by 30% of their balance sheet. And a lot of this money has moved into cash. Right? So it's ready to be invested wherever they see the return. How much? $3.5 trillion, of which we estimate that about $2 trillion is ready to move into the equities market, which is where India's space comes in the FII space. And on top of it, over the next 12 to 15 months, another $13 trillion is likely to be the stimulus from central banks of the G4 countries. So ample liquidity, cheap money is going to be continuously available. So not only is the outlook favorable, there is likely to be sustainable liquidity for the large cap space in India. And further to it, though domestic MF sold 16,000 crores of equities during this period, their AUM also has a bias towards large cap. So if FIIs for short periods are selling, 68% of domestic MF equity in 10 lakh crores, 6.5 lakh crores is in large cap stocks. So there is ample liquidity to support the large caps in case the FIIs sell for short periods of time. Right? So this bias towards large caps by the thing is likely, according to me, to increase because of the multi-cap guidelines, which is a contrarian view to what the market expected when these guidelines were announced. Let me explain myself here, right? So the circular and multi-caps basically said that essentially they were treated by the industry as go anywhere funds, right? And fund managers chose to put 70% in large caps, 20 in mid and small in 10. What the government has changed, so it was essentially a low volatile segment with 70% large cap. What regulator said, be true to label. If you are multi-cap, put 25, 25, 25 in each. And so immediately those who adopt that, this category will become a higher volatility category. So the expectation immediately was that this didn't say become riskier, is that about 41,200 crores was on a simple piece of paper calculation that large caps have to be sold and mid and small caps have to be bought. And there was a rally in mid and small cap, and people were saying, oh, this is what is going to happen. But sad but true is the fact that this is not going to happen. Why? First of all, the AMCs have gone back to SEBI with their case, and that's being discussed. Right? Second, so some kind of a solution will come from that. Number one. Number two, even otherwise, what will they do? They will either because their view is clearly that I need to be in large cap today. So they will either they'll recategorize their multi-cap funds into large or large and mid-cap if they are not already present there. If they're already present there, they will evaluate merging the multi-cap into one of those two segments so that they can remain true to their thought process that today 70% has to be in large cap. Then thirdly, they will encourage their investors and the distributors to switch from their multi-cap to the large cap. So all of these three things, if they happen, means there's no need to sell large caps and buy mid and small caps, by and large, right? So no action will happen. Only those AMCs which don't do any of this and leave it as multi-caps, they may need to sell some large caps and buy some mid and small caps. This is the AMC's actions I expect. What will the investors be doing, right? It depends on what the investor's risk profile is. If he chose it for a low risk, low reward, because it's a 70% large cap, then he will shift to large cap now. That's what he should do because he wants low risk. If he's chosen for moderate risk, no, I'm comfortable with about 30% is there in mid and small cap, I'm comfortable, then there is a large and mid cap category, which is ideally suited because it has minimum 35% large cap, minimum 35% mid cap. So 65-35 is what it is likely to be, and is being run down right like that. They will switch into that. And if they had chosen it for the flexibility, oh, today is 70% large cap, tomorrow it could be 70% mid and small. If you feel that flexibility is necessary, then now you have no choice but to do it yourself, because the new multi-cap doesn't have the flexibility. So you'll have to change it. What you have to do, you have to take out the money, put it into large cap, whatever you feel, mid cap, whatever you feel, small cap, and change it in the future. That is if you chose it for that. But otherwise, if you say, no, I am comfortable with high risk, then you do nothing. So if you see as a summary of this slide, I don't expect any significant selling in large caps, nor any huge buying in mid and small cap, though the people who are holding those stocks are holding on today expecting this buying, and hence the liquidity has tightened and you're seeing a spike there. But according to me, this is not going to lead to any significant huge jump in the demand for those. Right. So that being said, like I said, there's going to be FII flows into large caps, and MFs also have the enough liquidity in large caps to support it. So the outlook is that there's enough money for large caps, and you have seen the economic outlook. So now when you get to choose, I have to come now and suggest to you what to do, right? So in that context, right, first you need to look inward, because the type of investor will also decide the type of the mix. So first you decide your goals, and then you come up with a financial plan, ideally with the help of an advisor. Next, you judge your risk appetite. Again, an advisor will be helpful to you here. What is it? A simple session. Don't overcomplicate it. 5-stage ranking, 10-stage ranking of your risk. Just put yourself into either aggressive, moderate, or conservative. And it's easy to judge this because it's your genetic makeup. If your parents and grandparents are very conservative, you will also be like that. It depends on your dependencies. Lots of your aged parents and your children, very young children there, you'll be less risk oriented, right? So these are all things, and your temperament, basic temperament. So just to be classified, after which, don't put all your eggs in one basket. No, all in large cap, all in mid cap, no. Because as I showed you right at the beginning, there's a wide variance in returns across time. So what you should do in consultation with an advisor, I would suggest you diversify across Capco specific mutual funds, and then you keep regularly evaluating based on the business cycle. So based on today's business cycle, what I would suggest is that look at the rolling returns to judge the risk-taking capacity, because the past analysis has a predictive capacity for future. So the same set of data that I talked at the beginning of the presentation, I have now looked at it from a probability perspective. So what is the probability of the risk of capital loss? In large cap for 3 years, I will discuss, you can look at the rest as I speak. 7% is your risk of loss, which is 93% of the time your capital got protected, 7% loss. But it's 4 times higher for small cap. Right? So when I take you through the allocation, this is what will come into play. Your ability to take that risk 1/4 of the time on a 3-year investment, small caps are likely to lose your capital 1/5 of the time in a 5-year period. Go to 10 years, it's all hunky-dory. That's fine. Now, that's the risk part. But the reward part also you need to be aware of, right? Because when you take risk, you would like to compensate with that reward. So now you look at the reward. So what is the first reward, the benchmark? Protecting capital is not a reward. The first reward is you beat inflation, because generally bank deposit rates are also hovering around inflation. So today it's slightly different. Inflation 4.5, banks at 6, whatever. But post-tax is again at 4.5, right? Banks. So if you look at it, the reward of beating inflation, and here I've used a higher bar, I used 7%, right? Because long term, let us not look at a very low inflation. So if you see here, 70% of the time, large caps have given you inflation beating returns, but only 53% of the time, a small cap given you. So that is the extent of variability, right? And when you take the bar a bit higher, and you look at it as a double-digit return, and I want, no, not 7%, I want 10%. Then again, you see at around the double digit, they are broadly in the same pattern, 54, 64, 49. And whereas if you go to 15%, saying no, equity markets should deliver me super returns, 1/4 of the time here and 44 and 37. So as you can see here, clearly large caps have the lowest probability of capital loss, but they give you comparable high return probability. So that's one point, that if you're conservative, aggressive, this can be a good way to choose. So on that basis, right, clearly large caps are suited. to those who need capital appreciation over the medium to long term with a lower volatility. I hope that point was made. So now you should, based on your risk profile, you should be easily able to judge that if you are an aggressive investor, I would say in today's circumstance, you should have a 5-year horizon. But like I said, the V-shaped recovery imparts the need to be flexible, is that you start with a 50% large cap and a 50% mid and small. And maybe a year later, once you have seen the V-shaped recovery happen, you can reduce the large caps and increase the mid and small cap. So this is for an aggressive investor. If you are less aggressive, you are a moderate person, then I would say you put 70% into large caps and 20 and 10 into mid and small caps. And if you are a conservative investor, then I would suggest you eschew small caps and put 80% into large caps and 20% into mid caps. Maybe a year later, you can add 10% into the small caps once the recovery is visible. So on this basis, as you can see, especially for the next 1 year, the portfolio should have a bias towards large cap with the flexibility of alter, the reason being the current state of the business cycle, right? In fact, even if the expectation of business cycle changes, large caps can still form the core part of your portfolio at all times. So by mistake, you take a higher large cap and you're delayed in changing over. What happens to you? You look at it that over 15 years and 10 years, if you stayed in the large cap, you got point to point based on today 11% per annum, which compares very healthily with inflation and bank deposits, and you have the added tax advantage of equity of 10% versus 20% and 30% on other alternative bank deposits and other deposits, right? But this is point to point today. What if you did a rolling return so that you saw over a longer period of time what happens? So I've done this both for the Nifty 100, which is the benchmark for our fund, and Nifty 50. And as you can see, on an average, you have got double-digit returns, 3 years, 5 years, 10 years, Nifty or Nifty 100. So large cap should form a core part of the portfolio because for the safety, you are not giving up that much of a return, right? You're still getting, compared to your alternatives, better returns, right? Only if your aim and ambition is to get 15% plus return, do mid and small caps really form a part. And so they should be that portion which based on your risk-taking capacity, they should increase the mid and small cap component, right? So the risk-reward equation, which is whatever, that was only returns I looked at, no? So I wanted to point out from a risk-reward. So look at this now. So in the large cap, right, the maximum, that's the reward, right? The maximum returns, I thought average was 12, but if your timing was very good, the reward you get is 48% per annum on 3 years, 25% per annum on 5 years, and 18% per annum on 10 years. So like I said, if the timing is good, that is in that 10-year period, you've made fabulous returns. But what is the probability of beating inflation? That was maximum. Let's look at it from a risk-reward probability. So you see that 68 to 70% in 3 to 5 years, you are beating inflation, right? But in 10 years, that becomes 90%. So in large caps, if you stay for 10 years, your maximum return is 18, your average is 12, and 90% of the time, you're assured of beating inflation. What more do you want from an equity asset, right? Because the risk part of it is also minimized, right? Because there's a low loss potential with low loss probabilities. What do I mean? Look at it, 3 years, 5 years, 10 years, right? In 3 years and 5 years, your minimum return, that is what if there was a loss. How deep was the loss? It's only 6.8% per annum in 3 years. And if you stayed 5 years, it's only 2.3% per annum, the worst case scenario. And 10 years, all that gets wiped, you get minimum 3.8% return, better than your savings bank account. And the probability of that loss happening, right? Clearly, in 10 years, it's zero, right? Because the minimum is positive. But if you take 3 years and 5 years, what are you seeing? You are saying that your 5% is only the probability of getting that 6% negative. You're at the margins, right? Because what effectively you're saying is that 95% of the time I don't have loss of capital risk. And it's even less when you go to 5 years. It's only 1.5% probability of loss. So clearly, large caps have to form a core part of your portfolio at any time. The timing now is even better because of the situation of the economy, and hence we are launching our NFO at this time, right? September 17th to 30th.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.